Kathryn Rooney Vera, Baltic Capital Markets Chief Investment Officer, joining us to talk about that. Join us. Clearly haven't been here for a week.
All right, Kathryn, so to bring you in here, how do you view this, considering that there is a narrative out there that this is just going to mean easier policy, more stimulative measures coming from Beijing? Is that enough to support the Chinese markets?
I think if we're in Chinese equities, we have to be aware that they're going to go lower before they go higher. So I've been recommending consumer discretionary in the Chinese space for some time now. I think there's a threat to that now, given the irrational and illogical policy of zero COVID tolerance. So that to me says that we're going to get a lot of both. In terms of a hit to both inflation to the upside and to growth to the downside, not just in China, Kayleigh, but we're talking at a global level here. So if we were thinking stagflation was a scenario, it should be our base case now. It was our base case in Baltic research going into this year, and it is firmly entrenched now. I think we have to be increasingly cautious on the turn in the economic cycle. A recession is part of the economic cycle. It is inevitable. It's infamously difficult to predict, but it is coming. So let's position for those sectors that we know historically outperform at this point of the economic cycle.
So you are definitely not, by the sounds of things, Kathryn, in the we can achieve a soft landing here from the Fed camp. If that is the case, and you've laid out your case pretty strongly that it isn't, where do I want to be? Sort of give me some specific areas. Lay it out for us.
Absolutely. So the top performers in terms of S&P 500 sectors in stagflationary periods are energy, are staples, are utilities, and healthcare. So those are quantifiably the best performers in a stagflationary scenario. They're also very nice because they're defensive in the event of a recessionary period. It's going to be an enormous haul for the Fed to nail this smooth landing in this very difficult, economically decelerating period of high inflation, where the Fed has to both engage in decreasing its $9 trillion balance sheet, jack up rates with the market is finally pricing in the enormity of the task that the Fed has really entrenched itself in. So the Fed itself has engendered a lot of these inflationary pressures. They've far extended their expiration date in terms of policy accommodation, and now they have to play a huge game of catch up. So 50 basis points is already baked in, 75 is a possibility. We're going to get several 50 basis point hikes. The market is already starting to price it in, finally good. But the Fed is at the end of the day taking inflation seriously, and it has been very long in the tooth and coming.
So,
Kathryn, how are you thinking about a significantly stronger dollar and a dollar that stays up for a while?
I think it presents opportunities. I certainly agree with Damien in the fixed income space, even in the equity space. I mean, we can look at Chinese equities. I think they are going to go lower. They've gotten a hammering year to date. But I would be looking at opportunities to enter there because effectively China does have the ability to go for big fiscal stimulus, big monetary stimulus at the drop of a hat. So I do like China consumer discretionary, but I think we have room to go lower there. Within the dollar spectrum, of course, the dollar is going to be stronger before it gets structurally weaker, which is my base case over the medium term, over several years to come. But we have the combination of a massive interest rate differential between a Fed that is already massively behind the curve and an ECB that's massively behind the curve. But the interest rate differential favors the dollar, so does safe haven. So certainly we're going to get upside pressure and continue to see so from now through year end on the dollar before we see any weakness going forward. So this year I am bullish on the dollar. I do think there's opportunities in select emerging market currencies, specifically in Colombian peso and Brazilian real. They have done well year to date. That was our view coming into the year. I do see opportunities in the fixed income space, long duration, on quasi-sovereigns attached to the oil sector in both of these countries.
Kathryn, your thoughts on that?
Well, that makes a market, right? You have the buyers and the sellers. So I think that's fantastic. So yeah, I do think structurally over the long term, I would be starting to accumulate. So certainly there's different viewpoints. I think that consumer discretionary in China has a long upside potential for a sustained period of time. So if you don't have any, I think that we can start accumulating. Of course, this is not for everyone. I mean, this is for guys and gals that are looking for alpha, that are, risk tolerant and are looking to engage in something that can give them more sustained upside than, I don't know, 2.7% in treasuries or S&P 500. That's, you know, very close to where I'm seeing levels.
Are you looking at a Bloomberg terminal, Kathryn?
Yes, Bloomberg all the way. Bloomberg all the way. So yeah, I think that we have to, you know, be looking for opportunities in more juicy markets than the developed ones, where I think that we're going to see limited upside from now through year end.
Do you see limited upside as well for technology stocks, Kathryn? And this comes back to the story in China, especially those that are hardware focused. Supply chain issues and production capacity in Asia, a big issue.
Absolutely. I couldn't agree more. And that's where I started the conversation, talking about how both, you know, inflation and growth are going to be adversely impacted by, you know, this zero COVID policy in China, which means, you know, lockdowns in Beijing. So that's going to exacerbate the supply chain disruptions that we've seen, add to the inflationary story. So this isn't just Putin, right? This isn't just oil prices. This isn't even just supply chain distortions. This is monetary, fiscal. There are so many impulses to inflation. So what are the sectors that do the worst in this type of environment, a stagflationary / recessionary environment? Those are consumer discretionary, and that's tech. So I think we need to readjust the portfolios and realize that we are at that point in the economic cycle where we need to change from cyclicals to value and from growth to defensive.
All right, a lively conversation to start the week. Thank you so much to Kathryn Rooney Vera, Baltic Capital Markets Chief Investment Strategist.